My name is Jeremy Halpern, and I apologize for the pillar situation. I'll try and wander so as not to exclude people. I'm a partner at Nutter, McClennen, and Fish. We're one of the big law firms here in town and do a lot of work in the startup space. I also get the fun of spending time with 4 of the angel groups in town that we work with. Boston Harbor Angels, Thai Angels, Launchpad, and Golden Seeds. So see a lot of plans and pitches that side. And I'm also on the board and investment committee of Mass Ventures, which is a micro VC funding businesses here in the Commonwealth. So between that activity and TCN and Nutter, I see about 500 to 1,200 plans a year. And this is all hopefully distilled down through a lot of the TCN program to try and give you the benefit of some of that experience. And today's program is really designed to help you identify which path is the right path for your company. And oftentimes you'll hear people say things in the community like, oh, I'm going to go raise venture capital, and you get a little bit of data from them, and then you realize you should not be talking to venture capital. And we're trying to spare you a little bit of that pain and optimize your time. As you guys probably, how many of you are actively running a company now? How many are contemplating running a company? All right, well, as you with your hands up will find shortly, talk to the people who had their hands up, your time is by far and away your most precious commodity, your most precious resource in this business. So helping you make better decisions earlier, better planning decisions that lead to better execution is really just so key at the beginning. You really, really want to do some learning early on. So I'm going to run through a few slides. Yumin is going to give a little bit of color commentary, I think, and then we're going to turn it over to Paul to talk a little bit about convertible debt. And then we're going to open it up to questions from the floor, and we really want to get your active engagement. So quick rules of the road, and I do this at every program I participate in. We're going to play a game. The game is called My Undergraduate Major is Worth Less Than Your Undergraduate Major. Can anyone beat me at this game? Anyone? No, you're all life science people. Yours are like chemistry and biology, right? Well, mine is in medieval British history, and I have a second one to complement that in moral philosophy. And the reason I bring that up is to tell you that I had to learn the business, right? And if I can learn the business, Lord knows you can learn the business. And what that means is you can't really ask a dumb question. So the only dumb question is the one you don't ask, you don't get an answer to, and you walk away going, oh, I really wish I had asked that. No, don't leave with that feeling. Just raise your hand, ask the question. All right, let's see if our clicker, hey, all right. So we're really concentrating a little bit on high growth companies today, and that's going to, as you're going to see, come in kind of 2 varietals. But I also want to remind you, there's other kinds of companies out there. If you guys are thinking about opening up a gym or a bake shop or other kinds of things, those may be much slower growth companies, and they ultimately may be very profitable companies. But they're a different kind of growth path, and today we're really focusing on high growth companies. So what does that mean? And I don't know, can you guys all see that? I know the contrast isn't totally optimum, but we're really focusing on the 2 columns on the right here, right? And this is the difference between a high growth and an extreme high growth. And we're going to talk a little bit about the indicia that help you identify, which one am I? But an easy way to do a little bit of thinking about this is, are you going to be 10 million in revenue in 5 years or not? All right, let's take a giant step back. How many of you were biotech? Okay, we can all agree you're never going to have revenue. That's cool. It's not a problem. You don't have to slink out the back or anything like that. How many of you that had your hands up are combo biotech, meaning you're biotech plus device, plus health IT, plus services? Okay, you guys have hope. You may have revenue. How many, the classic biotech people? Building molecules, right. You will never have revenue, right? So this is not a useful indicia for you, right? Why do they not have revenue? Because they're going to build an intellectual property asset. They're going to build a clinical trial asset. And they're going to sell that to someone else who's going to ultimately manufacture and sell things. They will never manufacture things. They will never sell things. I don't know, what's the rate of biotechs that actually go on to sell things? Vertex and? Less than 5%. Right, yeah, okay. So basically no one, right? Okay, so we have to start looking at some other things as we work on you guys on the biotech side. But for the rest of you, and let's get a quick count. How many are med device? Some of you aren't sure, apparently. That was like a, depends what device means. Okay, health IT. Okay, health services, diagnostics, and the rest of you are confused. What'd I miss? Oh, okay, we're playing the not biotech, I'm small, okay, all right. Sorry, molecules I should have said, okay, fair enough. All right, so where do these fit in the world? Well, all of you probably remember from Econ 101 that there's an intersection between risk and reward. And the more risk you ask an investor to take on, the more the reward has to be. Why? Because if I looked at a portfolio of assets, if I did 10 deals, and I know in my head that a good chunk of them are going to turn to zero, right? Then the rest of the deals, the winners have to cover the losers. If I invest in bonds, which are a relatively safe investment, I don't assume I'm going to lose any of my principal, and I get paid very little for that. When I invest in equity, I assume some are going to do better than others. That means you have to pay a little more to those investors. Well, when you invest in this kind of equity, this is extreme high risk, right? And so you start thinking about, okay, I'm going to need a lot of capital, I'm going to have a lot of risk, that's going to mean some things. So what are those high growth characteristics, right? Well, the first, disruption. Okay, let's put up our hands, first moment, raise your right hand. I know you're eating, bear with me. Raise your right hand, right? Disruption does not equal different.
Disruption does not equal different.
That is correct, okay? I am different does not mean I am disrupting an entire marketplace. Yumin, how do you know if you're disrupting a thing? Versus just being different. How are you? Is the mic on? All right. If you are disrupting something, you are changing a fundamental characteristic in the value chain, right? You are not just another product who has a very similar who gets paid, who bears risk, who has liability for things. Those are differentiating factors. You know you're disrupting when you're completely changing the definition about who's bearing the economic risk, who's getting the economic opportunity. And you look at across a chain, that's when you really see, oh, I've got something disruptive going on. High margin product, what does that mean? What's a high margin product? How many of you think you have high margin products? Okay, that probably should have been the entire room. That worries me a little bit. A high margin product is a product where when you look at the unit cost of making the product, the cost of goods sold, and you compare that to the revenue on a per unit basis, they're very strong. What does strong mean? Well, think about software. What does it cost me to have you click and download another copy of a piece of SaaS software? What does that cost me? 3 cents, right? A little bit of server time, a little bit of tracking. If we add warranty and maintenance in there, okay, maybe it's 5 cents. So software companies' margins are in the 95% range, right? In the old days, you at least had the cost of a CD and FedEx. Not anymore, right? What does it cost to make a pill? At the front end, but not on the margins, right? When I'm making a pill and I'm at scale, what does an actual pill cost per pill? Not a lot. Actually, even the most expensive pill, the actual cost of the pill, the manufacturing cost, very small. What's the revenue associated with that pill? Well, either a lot or a little. What's the difference? How do you know if it's a lot or a little? Commodity. So if you look down here, right, down second bullet from the bottom, defensible, able to withstand competition. What do you get if you're in the drug business? You get IP, you get a patent, you get exclusivity. So when things are on patent, very high margin. When they come off patent, it turns into a commodity. It's a race, really low margin, but you hope you sell a lot more of them. Right? So Tylenol does okay not being on patent. They're not starving to death, right? High rate of revenue growth. This is all about once you're in market, can you add customers very efficiently, right? That's what scalable means. You can spread your infrastructure cost across the same revenue, right? So how many people are not sure what I mean when I say scalable? Okay. Same idea even in manufacturing, right? Which is, can I buy some equipment that then I can make a huge amount of product with, and I've amortized the cost of that equipment over all those units. All right.
So one thing about,
Please.
and I'll chime in, with the high growth company, I think what Jeremy said was probably mostly true. But in the healthcare world, there can be high growth companies that are not either with high gross margins, right, with a high growth company can be a new business model delivery, right? It can be a new way to deliver a drug. It can be a new method of payment. It can be a lot of different things that you think isn't disruptive, but in the healthcare world, it actually is very disruptive, right? I mean, we can debate all day long about the great new technologies that Google is coming out with and Amazon. Healthcare, man, cell phones are brand new, right? I mean, you look at Bluetooth, that's brand new. So you take disruption and you add it to the market, and it means something different, right? So as you're looking at high growth, this is a very generic slide that applies to any other company and any other field. In healthcare, there are certain things that are different within the high growth characteristics. And we'll go through some of that with Paul and as we get into some specifics.
Absolutely. So what does this mean when you see the view? If you were on the left side, right? If you're creating a company that isn't creating high margin product, isn't creating scalability, and in fact, if you're all the way on the nonprofit side, your sources of capital are designed to match that situation, right? I'm going to give you an annual grant. You're going to spend that grant. I'm going to give you another annual grant, right? Social venture, impact investing. And again, all healthcare investing is impact investing, but in this, you're talking about prioritizing impact over profit. So something that's really doing a business that's designed not to create a ton of income or capital for its shareholders, well, that's going to change where in the spectrum people are going to put that money, right? So that's when you go to your local bank, right? And as you go up the scale, you start increasing the risk profile. You have to start increasing the return profile, okay? And equity, ownership, is always more expensive than debt. That's sometimes confusing to people. Equity, from your point of view as the owner of a business, is more expensive than debt. Okay? If someone came along and said, I'll give you the same $5 million as Yumin at HLM Ventures, and they're going to charge you 20%, and you think, 20%? Oh my God, that's like worse than credit card rates. You know what? It's better than venture. What do you think IRRs are on venture? What's the rate you pay for their cash, all in? Well, he's hoping you pay him somewhere on the order of 35 to 40% a year compounded. That's how it works. He gives you $1, you give him 10. Some of you are making like wow face. I like that. That's awesome, right? So 20% starts looking really good, right? Except for one problem. How many of you have called the bank about your molecule business? I guarantee you security is not the issue in that problem, right? If you called up Citizens Bank and you said, I have a new molecule business, would you please give me $5 million? When they stop laughing, they'll just hang up, right? They will not give you money at that stage of the business, at the concept early stage of the business. They might fund you way later, as we're going to see in a second. But early on, the risk is so massive that getting paid 20% isn't worth it, right? And whether that's 14% for secured debt or 20% for unsecured debt doesn't make any difference. They're not getting enough back to merit the risk. All right, so we talked a little bit about who, this risk-reward profile. Who are the funding sources? Angels, angel groups, micro-cap funds, strategic and corporates who are playing an increasingly large role in the life science world. Average angel group deal last year put down around, it's just about to change, but it's around $750,000 in a first round deal. When they add corporates into it, the average is close to $2.9 million for a first round deal. Strategics are playing an increasingly big role. Who else is out there? Accelerators, the tech stars of the world, right? Bigger VCs, traditional VCs like Yumin's, HLM, right? So you got to understand who the different players are and why they're lined up with these different businesses. So if you went to an angel, a solo angel here in Boston, and you said, great, I have a business, we're going to probably exit for $15 million in 3 years. and I only need $2 million to build it. Does that sound like a good year, a good deal? Right, couple million in, 15 million out, sounds like a pretty good deal. If you called Yumin as a VC, he's not interested in that at all. Because traditional funds have to put more money to work. They have to get bigger returns, right? So you got to know who you're lining up with. And by way of example, a $40 million fund thinks about this world very differently than a $400 million fund. They have very different requirements about what they need. Non-equity sources, we're not going to spend too much time here, but let's make sure that we're differentiating some terms. How many of you have heard the term crowdfunding? Okay, that means like 4 different things depending on who you talk to. There's non-equity crowdfunding, a la Kickstarter, Indiegogo. That means you give them some swag, they give you some cash, and they wish you well. They never hear from you again, you never hear from them again. There's equity crowdfunding. Can't really do that yet. It's getting worked on. There's syndicated crowdfunding amongst accredited investors. You kind of can do that, right? Angel List, Gust, Proseeder, things like that. But what's better than all of those things? Pre-orders from customers. Why is that better, by the way? Okay, you're de-risking, right? You're proving your market if you've got a customer willing to pay you. Why else is it better? Why is it better terms? Yeah, they're giving you cash, you're giving them product, right? Yeah, but you owe them nothing after that. They don't have a piece of your company. All the growth that happens after that, unrelated to them. You keep all of it. They keep none of it, right? Customer money is always cheaper. Even if you gave them a 20% discount, right, for their cash, thank you for your cash, I'll give you a 20% discount, cheaper than 40%, right? So customer money is great.
Depends on the cost of customer acquisition, though.
So true, so true. Yumin's point is, if it costs you $80 to get $100 of customer money, you may have thought about this incorrectly, right? You want to spend $20 to get $100 of customer money, right? That's a pretty good deal. Credit from vendors. People approach their law firms, their accounting firms, their real estate, all of these things, and they ask for credit or support or deferral or discounts. There's a lot of that going on. Money from strategics. NREs, non-recurring engineering dollars. If you are solving a problem that a big strategic already has, and they would have paid money to some engineering shop to go solve it anyway, they're often very happy to pay you to go solve that problem. They get some IP as a transfer. At the end of that, you got the cash and you got to accelerate your own project. Equity. All right, we talked a little bit about the sources. Just to give you an idea of when you stage them in. So at the beginning, you're talking mostly to friends and family. What are they investing in? People. I guarantee you, well, maybe not, but most of the time, grandma has no idea what you do. Right? My grandmother used to say, "How was court?" I'm a transactional guy. I would say, "Grandma, if I'm in court, I'm in handcuffs." Right? But she would have invested into me, but not because of the business, because of the people, right? Then you move on, you start to go find early angels, individuals who are going to give you $5,000, $10,000, $25,000. Sometimes you'll find people who will give you $50,000 or $100,000 very, very early on. In life science, almost always that's because they have a personal connection to what you're trying to solve. So as you might imagine, it's a lot harder in health IT than in biotech, right? Most people don't wake up going, "Damn, that EMR system," right? But they've all lost someone to cancer or Alzheimer's, right? And so oftentimes that conversation is all about their experience of that and them wanting to participate in the solving of the problem, right? Then you move on and you get to angel groups and you start looking at numbers north of $250,000 and you go on and that may go up all the way to about $2 million. And you may go from group to group in a syndication process. And if that starts to not be effective, you need more cash than that. That's when you start talking to the VCs, right? And you start talk to the strategics. Yes?
What do you mean by portal style?
The question is what do I mean by portal style? So under the Jobs Act that was passed, there will be a form of equity crowdfunding enabled by things called portals. The SEC has not given the green light for this yet. It is to come, but this is the idea of effectively selling widely to the general public little drabs of equity to people. It has all kinds of downside to it, and we can talk about that at the end if we have a little time, but right now it's not an available option. Here's the stage, right? So founder, you're putting your own money in, vendors, friends and family, moving on to angels, moving on to syndicated groups and VCs, and that size goes up as the stage goes on. What's the cost? We talked about 20%, 40%. Well, grants tend to be free. They tend to have operational costs, but they don't have payback. And you go all the way up, and angels and VCs, very expensive. Believe it or not, private equity, less expensive because they take less risk. They're getting into the game much later in the process. What is equity? We're not going to spend too much time on this, but I just want to remind you guys, and when you give someone equity in your company, what this means is a combination of control rights that are negotiated and the rights to economically participate in the company. What does that mean? If the company earns money and sends money out the door, distribution, dividend style, those owners have a right to that. And the usual methodology is when you sell the company, they have a claim on the sale proceeds, right? That's what equity is. And it comes in various flavors. And TCN runs lots of programs to take you through all the different bells and whistles. But it's important when you're out talking to the community that you understand, are you selling equity? Or as Paul's going to talk about in a little bit, are you actually doing convertible debt, and what's the difference there? All right, so what are some comparisons? Here are some of the terms, right? Valuation, board seats, covenants, right? You can see each kind of deal has different terms and different market standards. The only thing I know is that when you do deals with strategics, the reason strategics aren't on there is that it could be anything. Strategics are driven by their own priorities, and they'll agree to stuff that angels would agree to or that VCs will agree to and everything in between. They have a far broader palette of things that they're willing to eat. Please.
A little more about strategics. What exactly are they? How are they different than a VC?
Oh, thank you. Great question. Strategics, as it turns out, can be just like VCs or a lot different than VCs. So strategics in healthcare tend to be very large institutions. In the life science, you're thinking about Merck, Johnson & Johnson, Biogen, Genzyme, right? And they have two pots of money typically. Now these days, maybe three. Pot one comes out of their corporate development. It says, I am going to go buy you or a piece of you right now, and we're going to acquire you later on. Then they have a venture unit, and the venture unit can usually come in the flavor of acting a lot like a VC, but they have access to all of the R&D resources of their internal folks, right? So if I'm at Sanofi Genzyme Ventures, and I want to look at a deal, and I can go back to my R&D team and say, what do you guys think about this? How can we help leverage them? What insight can we give them about our product pipeline? And the way you deal with them can be very complicated, and it's very specific to those situations. Health IT, it's going to be people like all the big computer makers. It could be people like Epic, right? The EMR systems. There's lots of different people who are willing to put money into things because it's solving some of their priorities. And the general rule is anything that's going to leverage their business, their P&L, their priorities. So what's the downside of strategic deals if they're better economically? You can get pulled completely away from what you were trying to do because they're trying to do what they're trying to do. They don't really care about you. If they could get to the same result without dealing with you, they'd be happy to do that too. Right? Please. Paul, do you need a mic?
Oh, you need a mic. Yeah.
So yeah, I just happened to be at Sanofi this morning.
That wasn't a plant, by the way.
What's that?
We didn't plan that.
Yeah.
All right.
So this gets complicated because Sanofi, for instance, has two different funds. They have a brand new one called their Sunrise Fund, and they have Sanofi Genzyme Ventures. So Sanofi Genzyme Ventures, this is an example, is sort of a traditional strategic fund, and they have a limit on actually how much they can invest, how much ownership they can take. So a typical model for sort of the traditional strategic is they don't want to take more than 20%. They want to be a minority investor. So Sanofi Genzyme Ventures sort of follows that strict model. but now they've decided to create another group that actually doesn't have the same limits. They have a little bit more freedom. It's a little bit more like what I'd call the chief technology office of a company where there's a little bit more freedom to explore. And then there's a third strategic thing that honestly, I have a diagnostic company for Alzheimer's disease, and one of our investors, actually, their limited partner is a big company. It's Nestle, but they function autonomously. So this is like a separate venture group. It's funded by a big corporation. Some people might consider it a strategic, but they operate more like a VC.
And the additional bucket of money that's out there is often what they're now calling their innovation effort, their incubation effort. It comes under lots of names, but Merck has one and J&J has one, and they all have something, and identifying what that something is. Is it they're giving you R&D resources? Is it they're giving you lab space? It's often hard to know. It's often very hard to know. There are other things for the med device crowd. There are things like M2D2, which is UMass Lowell's Medical Device Development Center. Wait, hold on, I got that wrong. M2, Medical Device Development Center. There we go. And that is giving access to the prototyping resources inside the university and their engineering group. So you can get very low cost engineering support for the med device crowd. Right? So what it is, you have to go ask a lot of questions and talk to people.
You can also have the university-led, academic development programs like Partners, right, has an innovation fund that is solely focused on internal, technology and IP that's developed within Partners Healthcare and spinning that out and providing capital to companies. And that's a pretty popular sort of model as well. And you're starting to see that from the bigger companies as well.
Yep. You're seeing interesting developments right now. It's a time of a lot of flux. So Children's Hospital, for any of you who work there, they have an internal fund as well called TIDO. So they're putting money in very early on. Through Children's, that comes back to them in the form of their royalties, right, downstream in their deal. So really an interesting time. Just a few last bullets there, but exit horizons and exit range. You can see this is what they're hoping for, right? The reality is angels are often in deals longer than 7 years. Paul will tell you a little bit about his story. VCs would love to be out in 4 to 5 years. The average exit right now in med device is closer to 9 years. Biotech is about 7.5, which is the reverse of what people commonly think. But that's what the exit timelines look like.
Quick question.
Please.
Can you define negative covenants 2 slides back?
Happy to. The question was, what is a negative covenant? So a negative covenant is typically something that's imposed by a bank, although covenants come in equity deals as well. And what those are requirements that you don't do things without the approval of your investor partner. In banks, it's things like capital requirements, liquidity requirements, you might have balance sheet requirements. In equity deals, those are things like can't change the nature of the company, can't go borrow money, can't go raise new money that's senior to me. You can't change the CEO, you can't partner with someone, you can't incur a debt over $50,000. All of those things need our approval of the investor.
Can't sell the company.
And that's the big one. The structure, just reminding you that when you're selling equity in a deal, these are new issuances by a company. These are not transfers. This is not you go into your personal piggy bank of shares and then give shares to the new investors. No, your shares stay in your piggy bank. The company issues brand new shares. So if I owned 3 shares before and I give you 1 share now, I don't have 2 and you have 1. I still have 3, you have 1. I've sold 25% of the company, not 1/3 of the company, right?
So you're diluted.
You are diluted. That's exactly correct.
Not necessarily for a high growth company though.
Explain.
So if you're at a high growth company, one of the things that we often contemplate is should the owners of the company take some capital off the table, right? So do you get a small liquidity event or an all liquidity event of your company? And that depends highly on whether you're going to stay in the company, whether you're not, you're transitioning out, right? There's a lot of different iterations of that. But there are situations where we provide liquidity to certain older investors existing investors, existing founders, management team members. And if we want you to stick around because we think you're great, then we will ask you to roll over some equity so that you have some skin in the game as well.
So just to make sure everyone's understanding, when we talk about being dilute, there's two pieces of this, dilution and liquidity. Dilution comes in two flavors. Dilution by percentage you never care about, except for control purposes when 51% magically happens, right? But you really only care about dilution by value. And I can prove that point to you by offering you, how many of you would trade 100% of your new startup for 1% to Facebook? Right, exactly. Right? Of course you would take 1% of Facebook, right? Percentage is not the issue. It's percentage of what, right? The thing has a value. So if you have 100% of something worth $100,000 or 50% of something worth $200,000, those are the same economics. Same economics. Maybe different control issues, but the same economic proposition.
But everybody struggles with that one. From the founders that may start with, if there's two co-founders, 50% ownership, all of a sudden, they're down to single-digit ownership in some cases. To investors, quite honestly, they're looking at, how much dilution am I facing when really even the investors' values is going up. But everybody centers on this issue of dilution.
And valuation is a topic that in and of itself we could take all day talking about, and there's a lot of different ways that we can talk about valuation. But for us as investors, remember, first of all, we want to motivate you as the entrepreneur to do well, right? If you're worried about your mortgage, you're not going to be focused on the business, right? So if it makes sense, there are instances where we will provide liquidity, which is not a new issuance of share, that is a transference of share, essentially.
Yeah, just for broad market purposes, 90+% of early stage deals have no liquidity option for you. Okay, the extent that you're going to see any cash is going to be in your salary, and that's the debate. There are instances where it does make sense to actually provide additional liquidity, but it's the narrow case, not the broad case. There was a question?
I was just wondering what you meant by a minor liquidity or partial liquidity.
Yeah, so the question is around what minor liquidity or partial liquidity looks like. So let's say you own 50% of the business, right? And we decide to buy all 50% of your stake. You have no reason to stick around in the company anymore. You've sold everything, right? So there's two options. I can either issue you more shares, or I can say, instead of me buying all of your shares, I'll buy 25%. I'll buy 50%.
But aren't normally you buying newly issued shares?
Not all the time.
That's the point, is that normally the broad case, yes. The narrow case, either the company is repurchasing some of your shares or the new investor is purchasing some of the existing shares. But again, it's the narrow case. I don't want to get everybody's hopes up like, ooh, I get my Series A and I'm going to get a nice check for a couple $1 million. Very rare. Yeah.
Valuation broadly for angel groups versus venture, let's say Series A round.
Sure.
Often we'll hear, and also a second part of the question, if you could discuss people coming in from an angel round financing and a valuation from what's up there, what you've seen and how venture values that.
We're going to have to return to the second question because I'm not entirely certain I understand it, but let me address the first one first. So the question was, what are the broad market spectra around early stage valuations? What's market? Two radically different answers. Med device, health IT, and diagnostics, one bucket. Biotech, both kinds, on the other side. Okay?
Even more specifically, how do you see the broad spectrum of angels?
Yep.
and valuation?
Yep. So in those contexts, the one side of the house, the average angel valuation for life science deals tends to be in the 2.5 million range is about the most consistent. It goes all the way up through $4 to $5 million. Again,
The problem with talking about valuation, I don't want to go into the wormhole of talking about valuation here, because in the healthcare world, it's very unique in that you can get grants, you can get a lot of non-dilutive financing, you can spin out of universities or companies where you've maybe spent $20 million developing a technology. So the Series A number may or may not really be relevant,
Yeah.
right?
The other big issue here, and Yumin's exactly right. So the companies you see, they go up the spectrum as you've done all those things, right? You've brought in non-dilutive SBIR money, typically NIH, sometimes DoD, DARPA, BARDA. That goes up the longer the asset has been matured and de-risked. On the biotech side, it's a little bit different. Most investors in an A round deal, even angel investors, don't want to own more than 40% of your company. Okay? Why is that? Because they want you to be motivated. And they know that there's going to be follow-on dilution. Well, in the biotech world, if you're going to need $100 million, this is one of the reasons angels don't do a lot of biotech. If you're going to need $100 million, right, and they're only the first few $1 million, and they still need to leave you with 40%, all of a sudden the math starts to not work out. Now they have to give you valuations that are astronomical, which the VCs can absorb, but the angels cannot. So you see very few biotech deals in the angel space. Those that you do tend to be highly capital efficient deals. The expectation is you can get out for less than $20 to $30 million, not $100 million.
Or structured deals, which we will talk about later, but you can have certain structures within the equity financing that gives you a boost in your return, or they may have been pre-negotiated exits. You say you hit a certain milestone, you'll be bought for a certain price or multiple. That's fairly frequent as well.
To finish the thought, venture Series A tends to be valuations more in the $5 to $10 million range. Again, because you're putting in another 5, 7, $10 million, and again, they want to equal 30 to 40% of the company. So as you think about the quantity of cash coming in, that gives you some indication of what the valuation is likely to be. But there are deals that are very different. You look at Flagship and the way that they structure deals where they own the asset and they're bringing in the management team, right? They may own 90% and the team owns 10%, and they flipped it around, right? So different kind of deals. Just want to remind everybody, start with the end, right? So think about how much money you're going to need. And we're talking about the first in a series of fundraisings here. And each time you're going to go raise money, it should be after you have an inflection point. What does that inflection point mean? You have de-risked the company. What does that mean? There's usually about 12 to 15 major risks for health IT companies: product market fit, defensibility, regulatory, reimbursement hurdles, technical risk, all of these different things, right, that you've got to go do. As you knock each one of those out, you have a major valuation uptick. That's when you go raise the next round, because it does reduce the dilutive impact of that new financing. All right, turn it over to Paul a little bit. Let's talk about convertible debt.
Okay. Notice how they turn it over to me when we stop talking about equity and start talking about convertible debt. Actually, not that many people know that much about convertible debt, and there are different camps. There are investors who don't like dealing with it, don't believe in it. But as an entrepreneur, I found that it's been a great mechanism for raising money at certain points in the life cycle of the company. So I'll tell a little bit of story of my company. Basically, we got some non-dilutive corporate funding very early on. Again, this is diagnostic technology. So we did a couple of research deals with Pfizer and Merck, and that formed sort of non-dilutive seed funding. We counted it as revenues, literally, and this was, exploratory money in exchange for data, basically. And I encourage you all to find alternative ways to sort of seed finance, to be able to, get to some proof points that your idea works. So that was very helpful. It also added some credibility. Now, first time we raised money from angel investors, and I had no clue what an angel investor was. And I think people are, it's becoming much more commonplace, but I don't know if you heard what Jeremy was saying, but the typical angel investor is not Bill Gates putting millions into a company. It is this guy here or me or someone else writing a check for $10,000 or $20,000 into a company. It takes a lot of those checks. Guess how many angel investors are in my company now?
300 or?
No, 80.
Oh, okay.
80. It's a lot of investors, right? And takes a lot of angels to, kind of put together these deals that are $500,000, $1 million. We've actually raised over $2 million in angel financing in the life of the company. And the groups are collectives of individuals. So that's kind of an aside. But our first angel financing was actually the first syndicated angel financing in the Northeast. We did it back in 2005. And it came because one angel group that had 40 members couldn't come up with enough money to fill the round. So out of sheer panic, I called up friends and family, and in a week doubled the amount, tapped them out, and then I looked around and saw there were these other angel groups, and I had this term sheet, and I went out and was able to get other angel groups to sign up to the same terms, and voila, syndication. That's what it's all about. It's getting people to sign up under the same terms. Well, it was a convertible debt financing. And why did I do a convertible debt financing? It was because I didn't want to set the value of the company prematurely. I didn't want to set a stock price. I didn't want to decide that the company was worth, 1 million or 2 million or 3 million or whatever it might be at the time, because we were at a very early stage. We were trying to really kind of get some concepts working, get some data to prove that our technology worked. So I did this convertible debt financing. Well, what was it? Basically, they're typically called bridge loans. So what does that imply? A bridge to something. So I had to spell out what I was going to accomplish with that money, and it was a bridge to an equity financing. So I knew that I had some things that I could get done for $500,000 in a year, but after that year was up, I was going to need an additional $1 million to progress to the next stage. So I basically signed up for this convertible debt financing, which said at the end of the year, or it had, there was literally a deadline down to the day, December 31st. I needed to raise $1 million by that date, and this debt would convert to stock under whatever terms were agreed to in this equity financing. And the people who signed up for this convertible debt loan would get a discount on that stock. And they'd get interest because really it is a loan that they're giving. So there's what's called dividend rate, and it's an interest rate, and it might be a number like 8%. There's a discount, and sometimes they're tiered under certain terms, but it could be a discount like 15% on the stock price and it could go up to 25 or something like that on the stock price of the next round. And then if it doesn't come together, what would happen if it didn't raise $1 million? Well, there are all these terms. What if things didn't line up how we predicted? Well, basically it became a steal. So I was signing up to a risk that essentially for $500,000, people would own a huge chunk of the company if I wasn't able to get to this next inflection point. And you have to take gambles in life. And I was confident, if I wasn't able to accomplish what I set out to accomplish, then, what was it going to be worth? So, if I didn't take the money, I wasn't going to get anything done. So swallowed hard, signed up to it, We literally had investors come over from Europe at the beginning of December. They just happened to see a scientific publication related to our work, got interested, and through this network that I didn't even know existed, I was able to fill out the $1 million follow-on financing, like a day before the deadline. And so that was first convertible debt financing. So then I go chugging along, raise a bunch of angel money and progress in the work. Well, get through all the preclinical phase of development, ready to move to clinical trials. Expensive, right? That's moving me up the ladder to this, next tier of venture capital. Well, what do you do when you get a toxic venture capital syndicate? You walk away. And that's exactly what I did. Ultimately, you have to live with your investors. And I had, investor with all kinds of promises from New York who put together a syndicate. And, one of the members of the syndicate became manipulative, and I didn't trust them, and they started trying to change deal terms. And there was a point where I was willing to take a risk of, again, tanking the company, or taking, either taking this kind of toxic money or doing an alternative. And I took the high road. I basically walked away from what was turning toxic, and I was feeling very uncomfortable. So what do? Went back to my loyal angel investors and was able to sell some more stock, under the terms of the last financing. Great. It got us to a certain extent. But that wasn't really enough. They knew that we needed to raise substantially more money. And here was another bridging situation. I needed time. I was buying time. And this time, again, it was a bridge to an equity financing. And the people who participated in that did quite well. They're happy people today because they got a discount on the next round. It did come. We raised substantially more money, and with that money went to clinical trials and built value in the company. But that bridging mechanism sort of gave us time. Again, we didn't know what our value was going to be in the next financing. There was some uncertainty around that, and it worked out. Guess what? I'm doing it again. I'm right in the middle of one right now. And it's one of the best times for my company ever. We've got fantastic phase 2 data. We were contemplating doing some sort of a strategic transaction. There was a little bit of talk about valuation. And it turns out the rules are different between biotech and device companies. If you're looking at doing a strategic transaction these days with device companies, you really either have to be at revenue or close to it. A very different equation than biotech. So we recognized that we needed to go all the way through phase 3 and get to FDA approval, take out the regulatory risk. So that implied raising another $15 million. It all adds up that I've raised $17 million to date, not even counting the revenues I was talking about from strategic, but needed to raise another $15 million. Well, we had a syndicate of investors, but they wanted to add to the syndicate, And so it's a situation where we needed time to do further syndication. Who do you go to? Your loyal investors. And the idea of doing a bridge was attractive again. Allowed the company to carefully select additional investors for the next round, deal with some uncertainty of valuation, provide a discount, some attractive terms that protect the investors. The fallback position is if we didn't do a follow-on round, they'd get stock from the prior round. Basically, so even though we've increased value of the company, kind of the fallback position is they get a discount by getting the prior round. And it's a win-win for everybody. So, you know, you kind of have to look at where you're at, what the need is. It's not a typical means of investment these days, but you have to be creative. The other types of loans, you know, there's one other type of loan that Jeremy didn't really talk about, that's secure loans. And there are companies out there that will, at a very high interest rate, basically put a lien on your business. So you're taking a loan, and if you're not able to pay back the loan, you're giving them your IP, you're giving them your business. So another one of those swallow hard, you know, is this something I really want to do? You know, gamble my whole business on this loan? Tough choices. But any kind of a debt mechanism, they are looking for something to secure the debt. You know, what happens if things go belly up? And, you know, watch those terms carefully.
So want to make sure you guys just understand the convertible debt mechanism and also where it's used and where it's not used. So when Paul did that in 2005, convertible debt was pretty popular, and people liked it, and they liked it because they thought it was simple, they thought it was much cheaper from a transaction cost perspective. And what happened over the course of a few years, particularly following the 2007 crash, was people discovered that that simplicity had a cost, which was there were unallocated risks in those deals. And in some of the deals, the investors got really burned, and in some, the entrepreneurs got really burned. And so the result of that was you now have a convertible debt deal that's actually pretty complicated and really doesn't solve those problems in terms of speed and cost, although it does still allow you to defer some portion of the valuation conversation. So what this is the investor's giving you some money, here's $1 million, and in exchange, we agree that $1 million will buy stock at the rate of the next deal when hopefully my price is higher, right? So they get less shares for that $1 million. But in exchange for you putting it in today, instead of a year from now, we're going to compensate you with the discount and the interest. Okay, well that's good. Back in Paul's day, that was pretty much the extent of the docs. Today, that comes with a cap. The investor says, well, that's great. You can go build value, but if you happen to get some poor sucker to pay $20 million in the pre-money valuation, that's not what my million's going to convert at. I'm not getting 1/21st of the company. We'll cap it, and we'll say, in no event will my $1 million convert at greater than 5 million. Well, now you're back to negotiating valuation, right? And then they say things like, well, and by the way, if you don't do that equity deal, not only am I going to maybe have some kind of thing that I own a lot of your company, I may own your whole company, right? We may be the only creditor out there, and I don't need security. You're insolvent. I'm your only creditor. You might have, your law firm annoyed with you as well. But other than that, we basically own the company. So you go and you do $1 million deal, you may have sold the company for $1 million. And these notes have terms on them. They have a 12-month or an 18-month or 24-month term. So these are complicated instruments. They've gotten more complicated over time. And they typically now are not available to early entrepreneurs from angel groups. They're available when you already have equity investors and you're doing what Paul is doing, which is you're bridging to the next thing. But you've established a relationship with them. They know you. There's a different kind of flavor. If you approach an angel group today, they'll usually, 99% of the time, tell you no. They won't do a convertible debt deal. So who does do it? Who's a great person to do convertible debt with? Yeah, friends and family, because you don't want to really negotiate with grandma, right? What's the value? I don't know. Right, what's the value of your idea when it's in your head? Nothing has been done. Well, on an economic basis, the discount rate would be about 100%. So grandma's, 10 grand should own 100% of the company. That's probably not good, right? Similarly, you don't want to tell grandma that her 10 grand is equal to 0.1% of the company because you're going to be worth $1 billion one day. So convertible debt's often a nice way to not have to fight with family and say, well, we'll go get someone who doesn't show up to Thanksgiving dinner to set the price later, right? So that's where you see it most often now. So friends and family, very early individual investors, or later on after you've done an A round and you're bridging between an A and a B or a B and a C. Questions on convertible debt?
Can you place evaluations on some of the social media type of personal devices and biometrics stuff? Is there a way of or source of being able to put some kind of valuation, that kind of like that bridge gap?
You
Where
can-
these are still not like, these are just like proof of concepts?
So a couple of things. We run a whole program on valuation, so I don't want to go down too much of a rabbit hole because it is a long conversation. But you can go out and get trend data. So the NVCA and the angels through Halo track deal data, and you can get some averages around various verticals, and they're very vertical specific. Business to business is consistent. Business to consumer is a world I don't understand. That's why he doesn't do those deals. None of us understand, and we have no idea why people in California are willing to pay $50 million for a concept. I don't know. Honestly, I have no idea. So when you get to a lot of these things, it's very hard to say why someone's willing to pick a valuation of a certain point. Usually they believe that it's more like a gold rush valuation. I don't care what your company's worth. I only care that they're willing to pay an absurd valuation too, and I just need to get in, we need to build a little bit and get them to pay that absurd valuation before they figure it out. And that's great, right as you're still going up the curve, right? And when I overpaid and then 2001 happens, or 2004 happens, or 2007 happens, right, all of a sudden you're left having way overpaid for a company and having no value usually in your equity.
Valuations are very market dependent, right? What's going on in the market, which market you're targeting, what are your competitors doing, what's the public markets doing. There's a lot of different factors. Your business right now could be worth $1 million or $100 million based on all those factors. So it's hard to know what's going to be the most prominent thing that affects your valuation without knowing all the different variables. And at the end of the day, it's whoever's willing to spend that money, right? Whoever's willing to give you that valuation is, that's the validator.
One of the things I want to make sure you guys are paying attention to is it is often very tempting as entrepreneurs to think that valuation is the barometer of which is a good deal and which is a bad deal. Okay? And so you spend your life thinking about who's going to give me the best valuation. There are at least 3 things wrong with that problem. One is any angel investor will tell you, you can set whatever valuation you want, but I get to set the rest of the terms. If you think that's a good deal for you, I've got a bridge to sell you, right? There are all kinds of ways that what is given with the left hand is taken with the right, right? Liquidation preferences, participation, dividends. There's all kinds of things that make a deal that you did at a $5 million pre-money way worse than a deal that you did at $4 million pre-money. Way worse, right? So you got to look at the whole of the terms. Number 2, a valuation today that sets you up for failure tomorrow is not in your interest. If you get somebody to pay you an absurd valuation today, and that lasts you for 12 to 18 months, then you have to go out and get more cash. And you have not built value from that post-money valuation, right? Someone said 15, and they gave you 5, and so you have a $20 million valuation, and you go out to the next round, and the most you can find in the market is someone willing to pay you 10, you are in bad shape. Bad things happen to you when you have down rounds. Worse even than the down round itself, which is they have what's called anti-dilution protection in the first round, and all of a sudden you're going to get hammered in ways you did not expect. You're also going to have very unhappy investors, and that's the beginning of the end of your tenure as CEO. Promise. 3, there are other kinds of terms in these deals, not just financial terms, that actually mean a lot more. And you heard Paul start to talk to you about something. I just want to hammer it home, right? Deal terms, raising money, this is the prenup. You have a marriage in front of you. If you hate your investors and they're sitting on your board, that's a bad deal. I don't care what valuation they gave you, right? It makes it like to get a valuation from people who you don't agree with philosophically, you don't agree with tactically or strategically, that's not a good deal. Not a good deal. Maybe you can give a little color commentary.
Yeah, it goes for your team as well. The hardest part, one of the hardest parts of running a business is when you run into someone who's actually becoming a very negative influence. And you got to make the hard choice of, really, kind of cutting out the bad apple. And it could be an investor, it could be a team member. It could be someone you were, best friends with 2 years before. But people can take down businesses.
So I want to point out one last funding source, and then we're going to turn this into Q&A. How many of you are aware of the Mass Life Science Center? Oh, that's not a good number. They have work to do. So you should all, like in your to-do list, go immediately to the Mass Life Science Center. And they have at least 2 programs. They're about to launch a 3rd if all goes well. The 2 that are live, free interns, the actual legit kind of free interns, where they pay them on your behalf. That's huge. And by the way, intern might mean, postdoc from Harvard, not, 14-year-old lugging trash, right? These are very high quality people that are usually being sourced for the intern program. Number 2, they have their loan accelerator program, and that says if you go out and you find equity investors, angels, micro VCs, and you've raised in between a band, you have to have raised at least this much, but not more than this much, they will match those dollar for dollar with debt. Very low cost, very friendly debt.
So as an entrepreneur, I just want to add a little detail.
Please.
Actually, you pay the interns, and then they reimburse you.
Fair.
So as a small startup and dealing with cash flow,
Fair enough.
very important.
Yeah.
It's not free labor.
Cannot be a postdoc. They cannot have PhDs or MDs because I've hired many of them, and they have to be, the highest they can be is a master's.
I apologize. Okay, thank you. The issue on the loan programs is it is debt. You are responsible for that debt. You are responsible for paying it back. Although the Life Science Center has been pretty clear that they have no intention of hunting down and killing companies that can't repay timely, and they're pretty flexible about working with companies who are undergoing some kind of change process.
Last I checked, it's 10%. So in your opinion, 10% is not that high.
Oh God, no. Nope. So one thing Paul said I'm going to slightly disagree with, which is he said there's a thing called secured debt out there to get IP on your company, right? They get a lien on the IP, a lien on the assets. That is true if you are already a later stage, growth stage company. I pretty much promise you if you called any of the secured lenders in town for your early stage concept level company, no one is going to give you money.
Right. It's generally alongside other money
Yeah.
coming in.
Okay, so if you're thinking about, 10% when I'm really at equity risk kind of premiums, I should be paying people 40%. 10%, steal. Take all you can get.
So what do these interns do?
Maybe doing research, maybe doing market evaluations, maybe doing anything you need them to do. Just for clarity, because occasionally there's confusion, the state of Massachusetts does not allow you to have unpaid interns. They find that to be a violation of that pesky no slavery rule, and their point of view is you are failing to pay wages, you are failing to withhold from tax point of view, and you have personal liability to the state to the tune of treble damages for that, to that employee who can show up much later on in the process and go, hey, you forgot to pay me. And it doesn't matter what they signed. You can have them sign in blood. You don't need to pay me. Doesn't matter, you do.
Has this been enforced in the life sciences?
It has.
It started with the movies, right?
No, it actually, it's been for a long time, they've started to be much more aggressive with early stage companies around this issue. The attorneys general in most of the states where there's high entrepreneurship populations have started to crack down. And honestly, co-founders have sued their former companies and gotten paid. I mean, it's kind of crazy, but true story. So just want to remind you, equity comes in flavors, angel group, micro VC, traditional VC, strategic. There are loans out there through things like the accelerator program at Mass Life Science Center. There are accelerators like Techstars or HealthBox on the life science side. There's lots of these things, and then there's all the stuff on the vendor side, right? If you can get into Lab Central and you can get low-cost access to mass spec, that's a form of financing, right? It's anything that's going to drive value into the company. So there's this big range of options. With that, I want to invite you guys to sit, and I'm going to ask them a couple of questions to get started, and then I'm going to really turn it over to the audience. So, Paul, Paul, you've got a lot of angels. Yumin, you're with HLM. And maybe actually you can give us 2 seconds on what HLM is for those who don't know.
Yeah, so we're a traditional venture capital firm. We've been around, we started in 1983, so we've been around for 3 decades. And 2 things that are kind of unique about us. One, we only focus on healthcare, but non-biotech. So all of you out there that do biotech, I'm not your guy. Secondly, most of our limited partners, investors in our fund, are strategic partners. So what Paul was talking about with one of his investors is very true with us. We have 5 of the biggest payers as investors, so large, insurance companies, as well as several large IDNs, integrated delivery networks like Partners Healthcare, Memorial Care. There's several of them out there that are investors in us. We also have several large retail companies like Walgreens and Bosch as investors as well. So that gives us a unique insight into reimbursement, distribution, competitive pricing, what have you. So we can help both on the front end when we're doing diligence on markets or looking at companies, but in the back end, obviously for portfolio companies, it's helpful when we're able to make the right introductions at the right time to the right people. And that can be pretty helpful.
And if you had to guess your average Series A deal size?
So we like to syndicate. So there are lots of flavors of venture firms out there. My firm likes to partner. Well, we understand we're not the smartest guys around the table around everything, and so we like to bring in other smart investors. So our model, we have a $100 million fund right now. We like to put in $4 to $5, $6 million checks up front, and then we typically reserve another 100% behind that since we invest in earlier stage companies. But our typical round size is anywhere from $5 to $10 million.
Okay. So my first question for you is, Paul, you have 80 cats you're herding under the name Angel.
Yep.
Yumin, you're on the VC side. In a company, those angels and those VCs are going to sit on the board. Can you maybe contrast how you see the value of the human capital coming from those different sources, from the angel side, and Yumin, how you think about the value, the human capital value VCs bring?
Mm-hmm. Well, look, the typical angel investors around town are entrepreneurs. They're entrepreneurs who are giving back. So what I've found with my earlier board that was just made up of angels and sort of people that they recommended as independent board members was sort of very hands-on, almost like an extension of my staff. They were there to help. There was informal emails every day, and a lot of banter, a lot of communication, a lot of camaraderie. When we stepped up to venture investment, one thing I want to qualify is, our lead investor is European, and I've come to realize that there's sort of not to generalize too much or stereotype, but there are different attitudes in Europe VCs than in the United States.
Such as?
Pointy shoes.
What's that?
Pointy shoes.
That's not an attitude, by the way.
Right.
Yeah. I think actually when it comes down to compensation issues and ownership, I don't think it's a little bit more of a battle, I think, with the European VCs around the idea that employees in a company are going to be more driven by a sense of ownership than just a salary. So fighting for stock option plans and things. I get the sense actually from what he says that he gets it. That you want to make sure that people are properly incentivized from an ownership standpoint. That's what as you go through rounds of financing and the cap table, which basically is the profile of who owns what, changes. What you always want to do is make sure that the quote management, and I'm a believer in all of the employees of a startup company having ownership in the company. So basically the team has a set of options that and a pool that continues to grow as the value of the company is built up. Because you run the math on, say, founder stock that original 50% that you might have owned, you go through multiple stages of financing, and common stock really takes a beating. So, stock option plans are one thing that's different. But
I'll jump in.
Yeah.
It's your attitude, it's your background, it's how you think about the world, and the hard part to generalize with any angel investor or even venture investor is that your style of investing needs to match up. It's a fit. It's a marriage, right? Actually, it's even worse than a marriage because
Yeah.
you can't get out.
Yeah.
You can't divorce your board member,
Yeah.
right? There are contractual obligations that you can't
Yeah.
just disconnect from. So it is purely, not purely, there's a lot of different factors, but a lot of it has to do with just your communication style, your fit, how you get along. I've met lots of great angel investors that provide a lot of value because they understand the industry or they're great mentors to certain people, and that really is about the connection. Whereas there are lots of angel investors, and this is the same with venture investors, that add no value on the
Right.
board. So it really depends on what you're looking for and how you connect with that person. And venture as a whole does not mean you're getting great advice, you're getting great board members. It really depends on who in that venture firm, who you connect to. And it might not be the best investor in the world.
Sure.
It may not be the most prominent venture firm. It may not be the most senior person or the most junior person. It really depends on how you're connecting as the management team, the founder, the CEO with that investor.
Right. And I think there's this concept of, quote, smart money versus just money, and there are, firms that are, purely financial investors versus firms that have deeper business expertise and really can help with the business strategy.
The big difference, I would say, between an angel investor on a very generalized basis and venture investors, that a venture investor, we are investing other people's money. I mean, our money as well, but we're getting money from other institutions, right? Whether they're pension funds or strategic limited partners, we're getting money, and so we're investing other people's money and our money to companies. And this is our job. 24 hours, 365 days out of the year, this is what we do, right? Whereas an angel investor, there's a lot of different reasons why they may be investing. Maybe a full-time job, it may be a part-time hobby, it may be because of personal, social reasons. There's a lot of different ways. Whereas a venture investor, we have to drive a return back to our investors. Our fiduciary responsibility is to make sure we are good stewards of our investors' money. So we have certain requirements that we have to meet, right? There are certain obligations. When we go out and pitch our fund to investors, we say we're going to invest in certain types of companies, certain stages of companies. We're not going to go above a certain amount of money or risk, or we're not going to go under, right? So there's a lot of different things that we promise to our investors that we have to abide by, whereas an angel investor may or may not really have any, right? It's their own money.
Well,
typically.
it's their own money to lose, so, they don't want to lose their own money. You don't want to lose your LP's money, but...
So you guys probably did the math and realized that Paul's company's been around a little while, right? You heard 2005, and some of you were thinking, wait, what?
Yeah.
Right? It's not 2 years and you're out? I'm confused. Can you guys maybe contrast a little bit about the difference between a fund and how that's structured and what that would mean for a company like Paul's versus the angels?
Yeah, so for us, this is a very typical venture fund. You have a 10-year cycle, right? So you raise a fund, let's say you raise a $100 million fund. We're supposed to invest that over 10 years. And the way it breaks out is you invest around 3 years actively in new companies. You have a 3-year, so that's new investments. Then you have another 3 to 4 years of what I'll call a growth phase of the business. You're trying to mature the companies, get them to high growth portions. And then there's a last 3 to 4 years where you're harvesting those investments, right? So that's how we break out internally in our head the investment cycle. Now, there's companies that will sell 2 days after you invest. Very rare. It almost never happens, right? But it can happen. There are companies that sell 15 years after you invest. And for those latter years, obviously it's a 10-year cycle, we have to get approval from our investors to go beyond the 10 years. And sometimes it happens, sometimes it doesn't. And the investors have to okay it. But typically we look at the fund as a 10-year cycle, and we try to get out of all of them within 10 years. right? So when you talk to a new venture firm and you're trying to raise money, what is your vintage that you close your current fund is a very important question, because obviously if I'm deploying new capital, I just raised the $100 million yesterday, I may be willing to take riskier bets because I know I have another 10 years to go versus 3-4 years down the line when I know that the time frame of an investment that I need to reach an exit point is much shorter, right? So that's in the back of my mind, and it's the same for our fund right now. We're getting to the end of our fund. We're raising a new fund right now, and the way you think about investing is very different. We're very selective. We're only looking for another 3-4 investments, so we're not investing in any interesting company. We have very specific types of companies we're looking for, stages of companies, specific markets we're targeting, right? Yeah, you had a question?
Yes, so based on what you're saying, is that to say that you don't, so the funds are sequential, is that normal as well as the simultaneous funds so that you could get in different?
So the question is around the sequential nature of venture funds. You'll see that most venture funds, if they're successful, have multiple funds, fund 2, fund 3, fund 4, right? It goes on. And the way our documents, legal documents are set up, it's that we will not invest in 2 funds at the same time, right? So once again, going back to the timeline, we have to invest fully in new companies before we get into the next fund. So let's say I invested in 15 companies in fund 1. The next fund I raise, fund 2, I need to start concentrating on investing out of that fund. I can't then, 3 investments down, say, oh, by the way, I found another company in fund 1 that I could invest in. That's not allowed, right?
So, I mean, this is a very important practical issue for an entrepreneur raising money. There are lots of venture funds out there, but depending on where they are in their cycle, they may or may not have money to invest in your company based on your profile. So finding those firms that are the right fit in terms of the stage that you're at, the amount of money that you need to raise, it's quite a bit of research.
And I'll go back to the point about your time, right? There's roughly speaking 75 venture funds in Boston. Most of them don't do life science deals. So figuring out, right, first narrowing is who's doing your kind of deal. Second one is who's got a fund that's currently investing in new deals. Then we're down to Yumin's point. What about the partners? Do they have expertise in your area, right? So doing a little bit of that homework and funneling down allows you to go take meetings on a much more efficient basis than, let me go talk to a bunch of people an hour at a time that actually have no money to give me. And the same holds true with angels, right? Find out what they're interested in. Are they currently writing checks or not? Be efficient with your time and value it. Question in back.
So, so if you invest in a company and you cash out after a year or two, and you reinvest that distribution or you have to return to the investor?
So the question is, if I exit out of a company within the first, after I invest a year later, we exit the company, with those proceeds, can I reinvest in other companies? The question is maybe. I mean, the answer is maybe, right? It depends on how.
Can you in your current fund?
We can.
Okay.
Now, but we cannot reinvest. Once again, going back to the first gentleman's question, if we had fully invested out of a first fund, and fully invested means you've invested and you've committed capital to the portfolio. You cannot invest in new companies if you've now started investing out of a new fund, right? So, I'll give you an example. If I invested in 15 companies, that's all you did in the first fund. You raise another fund, the second fund, and you start investing out of that, and you get an exit from one of your previous funds, right, previous companies. I can't take that proceed and say, I'm going to invest in a new company now. Because your job is to be investing the second fund, right? Your investors are paying you to invest for the second fund. Your investor, previous fund investor, they may not be the same, right? Because you raise a fund, some investors may say, I like this fund, I'll invest, or whatever situation. Then 3 years down the road, 4 years down the road, you raise a new fund, there may be different investors. Hopefully the existing investors carry over, but they may not be able to in some instances, right? So then the first set of investors are saying, hey, I'm paying you to get exits in the company. I'm not paying you to invest in new companies. And the second fund investors are saying the exact opposite. I'm paying you to invest in new companies, right? But recycling it's it depends on how the fund is structured, and to a certain percentage, it may not be 100%. Most likely it's not. They'll say, you can recycle up to a certain percentage, but it's usually recycled with your portfolio companies, your existing portfolio companies, not new companies.
To contrast, Mass Ventures, we're an evergreen fund. So as we harvest, that is the source of our new capital. It's not from new money coming in, right? So it's its own engine.
Another question for you. So I have read in more than one places, the last 3 years, the biotech of pharma, life sciences, particular drug business, the could-be devices, the VCs have just gotten their principal back. The IRR has been almost zero. Is that true?
So I'm not a pharma guy, so I don't do pharma. That being said, there's two comments I'll make to that. It's not surprising that you're getting depressed returns because the market's shifted back, right? So starting 2007, 2008, the market just drastically went down, and you're starting to see the IPO market open up for the biotech side, right? So you're seeing, I think there's 140 companies in the IPO pipeline or something crazy. So you're starting to see that come back, and it's highly dependent on the market. Secondly, what you're not seeing, that it may be unfair for you to say they have only returned capital, is that a lot of deals now are not front-end loaded. What I mean by that is you may get a certain amount of money back right now, but based on certain milestones in the back, years down, depending on what you're delivering, what you're promising, commercialization, whatever strategy, you can get more out of that.
So
Right.
let me make sure I'm using the small words. He's smarter than I am, right? That means when you sell your company to Merck, they give you $100 million now and maybe $400 million later, depending upon what happens, right? Now, of those are called milestones or structured deals, and in those milestones, statistics right now for venture-backed companies are about 50% of milestones get hit and pay off, roughly speaking, about 50% of the value. 75% of deals are structured, right? Meaning you don't get paid up front. So, to Yumin's point, there's a lot of value that's yet to come in those deals.
Yeah, so I think especially in the biotech side, I know that's happening a lot more because they're saying, I'll buy you right now, I'll pay you whatever, 30 million, 50 million, 100 million, but if this works, I'll pay you a lot more, right? So I don't know what statistic you're reading, but it may be that you're looking at that front piece, not the back end piece.
And actually, I talked to one VC, and he also said that in the last 3 years, we have been very lucky to have gotten our money back.
Yeah, venture's tough. It's not easy. I mean, it sounds easy, but think about it. You have a $100 million fund, and you have to, and we can get into fee structures and everything, but typically it's a 2% fee structure over 10 years. So you're already starting at $80 million if you have a $100 million fund, and I can bore you with the details of the logistics of that, but you're already starting at a negative. So you have to get back to just a positive to return capital. And then from there, if you look at the portfolio construction of venture, right, especially in biotech where you need a home run, there's a lot of companies where you're getting zeros or ones or very small returns. And you need to make that up with a huge hit, 10x, 15, 20, 100x, right? And it becomes a very difficult sort of mathematics problem.
All right, question here.
Is there a master list of venture funds and and companies out there, plus the angel networks or whatever?
There are two places you ought to go look. For VCs here in New England, there's the New England Venture Capital Association, nevca.org, I believe. Is that right, Meredith?
Yes.
Yeah. And they have a list of the VCs that participate there. On the angel side, the angelcapitalassociation.org. And you look on member groups and click on the Northeast, and it's got most of them. There's about 23 in the Northeast right now, and there's a couple of new ones that are still trying to sort themselves out, and there's one or two that are national platforms. Investor Circle, Golden Seeds.
It's not NEVCA.org.
NewEnglandVC.org. NewEnglandVC.org. Thank you, Meredith. So that was your first question, where to find them?
Second question was, when you raise money from family and friends for the convertible debts kind of deal, do we have to be a qualified investor, or this could just be a loan kind of thing? Or be loosely?
Ask the lawyer.
Got to make them turn off the tape. The answer is it's complicated. If they have a personal relationship with the founder and the company, and they're in a position to qualify the risk of the company, typically they don't have to be accredited. It operates under some different SEC exemptions. For all of you, to the extent you care, the federal securities rules say a very simple proposition: thou shalt register all transactions in securities. That means as in file with the SEC, go public type transactions. Or thou shalt be exempt. And the list of what is an exemption is very specific and has a lot of permutations. And then some of those exemptions cut out the ability of the states to also regulate you, but some do not, which means now you have to comply with all the federal rules and you have to comply with all the state rules and typically all the states where all of your investors are. Right? That can be very expensive and very complicated.
So not to make people fall asleep, ask a lawyer. Ask Jeremy, right? Don't do it on your own. Talk to a lawyer.
Well, Paul, you did that. I mean, I assume $10,000 check is not too hard to write. It's a lot easier to write from lots of people. But again,
Right. The documentation to qualify an investor is not significant, really. It's a basic thing about their net worth, and you just have to do the kind of formality of qualifying them, or they sign something that basically attests that they're a qualified investor.
The securities rules are generally complicated. Right now, they're also in a lot of flux. And so it really is, this isn't just a self-promo. You really do need a lawyer. It's up there with, once you have a business, don't file your own tax return. That's a recipe for unhappiness, right? So there are places where go get good service providers. In fact, where's our TriNet? In front of me, right? A great example of when you've got, if you're going to hire a large force and you're going to have lots of complicated things around benefits and you don't know how to deal with that and it's a bad use of your time, go get a great provider like TriNet, right? Your time is so precious, and anything you can offload that is non-core to your product development, it's usually worth the cost to make it go away. This question.
I have a question for Paul. Will you comment on your self-funding stage of your business? I mean, how much and what did it take before you felt that you had the business plan and the value proposition to start approaching angel investors?
I think we had raised about sort of $80,000 or something on that order in personal loans to the business. Very simple mechanism. Yes, they were convertible loans because we knew we'd be raising financing. And none of us expected to be paid back, But yeah, I think it was about $80,000. And then in my particular company, we actually were able to consummate the strategic deal that I talked to you about. Pfizer was actually the first deal, and that was close to $500,000 before we raised $1 of angel financing.
Just to give you a little color, for any of you who think you're super tricky, giving yourself preferred stock doesn't work. Loaning the company money and thinking that will get paid back out of investment proceeds, good luck with that. I wish you the best. Odds of success, 1%, and probably annoying to your investors, right? Who again are saying, I'm putting money into this. Everything that you've contributed to the business in the way of cash and sweat and IP is contributed to the business. There's nothing that will flow back out right after we close the deal, right?
So you're saying the founders share common stock for the time and IP they're putting in, but some of the founders put in cash. You can't structure that cash as a convertible note so the person who gave the money gets the first stock later?
Very rarely. Cash, you can sometimes make the argument that you're going to get preferred, but usually not. Usually they're going to force you to convert all of that as part of the pre-money valuation.
So on the venture side, we will, depending on the amount, we will let you come into the preferred round. And that depends a lot in your position, what the value provided to the company is, how much capital you've put in, and really how much capital we're putting in as well. And what we think your future ongoing participation in the company is.
I'll put it this way, I've been doing this 15 years. If you've put in less than $1 million in cash, the opportunity that the preferred investors, the venture investors, want to have you in their class and dealing with them for class level votes and other kinds of things, really unlikely.
What about in the angel groups when you're doing a syndicated angel round and
Very
some
similar.
of the founders want to put in on the Series A?
If they're reinvesting again, their cash will be treated no different than anybody else's cash. But for prior invested cash that you've documented as a note, no. They're going to make you convert that. They're going to treat it as a contribution to capital. You don't even have to convert it. It just disappears and your tax basis goes up in your existing shares. Yes?
So, as far as employment is concerned, could you, so if you're working with people, can you hire them independent contractors? Would that, take care of the employment, as the employment laws?
All right. So if I looked
Get
over,
free interns, right?
if I looked over at the average accelerator, we'll call them mass difficulty, right? 99% of the business in there are violating any number of regulations. Almost all of them are violating some form of wage and hour. And the reason is they're doing one of two things. They have people working for free. That's a no-no, because again, you're not paying the minimum wage and you're not withholding. And two, they are misclassifying people, which means that if you are calling someone a contractor to avoid paying them your share of the employment taxes, right, and you're sending them a 1099, and the state and the IRS determine that you are wrong, very, very bad things happen to you. And oh yeah, the number one thing that comes up is when you have a contractor who gets canned, who no longer likes you, and who finds a way to make your life difficulty by probably filing, what does it amount to, 2 pages of paper at this point with MCAT or somebody. And what they say is, I should have been an employee. And by the way, I want my unemployment insurance that you forgot to pay for, right? And what is the test? It's multi-part. It generally means if you are hiring someone to do something under your command and control that is core to your business, even if they have another job doing the same thing, they are probably a part-time employee, not a contractor. Contractors do things that your business doesn't do, right? When you hire a law firm, you're not in the law business. So that's easy. When you're a biotech company and you hire a biotech researcher, that's going to be really hard to get out of.
But as a device company, you're hiring our software engineers, you're hiring people who do bowling.
It's all core to your business.
But if you only need them for 3 weeks at a time.
You hire them
right?
as a contractor.
You hire them
Yeah.
as a contractor. So what is there's some limit.
The point is, you may hire them as a contractor. That's what most of you are going to do, and you're probably going to 1099, and some of you will be wrong.
Or hire them through some other contracting company, which takes their cut and services it.
Yeah.
Is it easier in California?
I'm sorry?
Is it easier in California?
Way to
No,
move.
it's worse in California. I am also a California lawyer. I started my career out there, and it is worse, not better.
Just related to this question, is there such thing as volunteers?
Nope. State of Massachusetts says you cannot volunteer for
But
people.
what about the founders?
You're getting equity. You're getting paid. They equate your minimum wage into your equity, although it's an interesting case. We have yet to find out how far that you can push that.
Is it just an application applicable to companies, volunteers?
Correct. And unless you're a nonprofit, you basically can't get volunteers, in which case it's considered a donation of services to a nonprofit.
And I had a second question, which is different. Would you recommend to, because I'm just new to this, would you recommend to start with undiluted funding, such as, for example, applying for grants such as SBIR with NIH,
Sure.
and just stay with that without any angels?
The question is, do we recommend starting with SBIR or other kinds of non-dilutive financing? I think we'll all have different opinions. I'll tell you my point of view, which is if the grant is core to moving your product forward, and it is not going to take you more time to get that grant than you could go get a bartender job and get paid tips and equal that amount of cash in the same amount of time, then that can be a good thing. The moment you take grants that are non-core to mission, or like a Kickstarter campaign, if you spent 100 hours to raise $10,000, you have miscalculated your worth. right? Because you could go get a job as a contractor to make $100 an hour and take that cash and put it into your business. You would have been better off, right? So that's kind of my point of view. Investors, equity investors like pre-existing non-dilutive financing, again, if it is driven value. It's all about has it driven value. So if you can get a great example, Avaxia, right? They got a huge check from BARDA, which is the biowarfare division of the United States, right? Why did they care? Because they need to manufacture protective agents against things like sarin gas and other things. Avaxia is a company that is a biotech company building monoclonal antibodies, did I get that right? For irritable bowel disease, and they are doing that out of bovine colostrum. Yes, they are milking cows that they have injected with things in order to generate these substances. Well, as it turns out, that's a great way to make these things that BARDA needed. And they had to figure out how to scale their manufacturing anyway. So they took a huge grant, they scaled their manufacturing, they handed BARDA their substance. It all worked out, right? That was huge. And that made a huge difference to the investors when Barbara Fox showed up and said, I've already figured out my scale manufacturing problems on somebody else's nickel.
My spin on that is I agree with Jeremy, but it depends on what you want to accomplish.
Fair enough.
Right? I mean, if you want, there are very successful companies I've looked at that have raised tens of millions of dollars of SBIR, NIH, whatever, grants, and they love doing it, and they keep getting money, and they do research, and it's a great business model. That's fine. That's not something that venture capitalists may necessarily be able to invest in, but if that's what you want to accomplish, then that's fine, right? So it really depends on what you're trying to accomplish with that business and, frankly, with your time.
And I will say, by the way, that sequestration changed people's calculus about whether that was a great business model.
So what you're saying is if, say, I exist on SBIRs and NIH money, then you wouldn't want to invest in that?
As long as it's adding value, like Jeremy said, right? If you're taking that money and developing whatever that it has nothing to do with what I want to invest in, that SBIR, even if you have $9 million in SBIR grants that created this great technology, if it's not applicable for the commercial strategy of the business, that has no value to me.
Very concrete example. Last week, company came into our venture firm, robotics company. They have huge contracts out of NASA, right, and grants. And they're doing things on that side that are really interesting, and the geek part of me wants to talk about it. But the investor part of me doesn't care. Not only do I not care, it's an active distraction to the part of the business that I want them to be focusing on. So we actually, the entire conversation around the table was, how do you get back to focus, right? Should we be shutting down that entire portion of the company or redeploying those people as a predicate to our investment? Because otherwise, it's really hard to manage two things in parallel.
So I'll just give a little alternative viewpoint. I mean, if you're just getting started, you have to develop your idea to the point where it's attractive to him or attractive to the angel investor. And I think it's a real problem these days. How do you incubate something? You know, there is the traditional model of people mortgaging their homes and, you know, throwing their life's assets into something. I wouldn't personally do that. You know, I wouldn't take that personal risk. There are people who do that. But somehow you've got to fund, you know, kind of cooking your idea to the point where it's going to become attractive to an investor. And I think if, you know, if you're have an affiliation with a university, I'm all for, you know, doing as much as you can under the umbrella to get it to the point where it's really can be launched as a business. The farther you're able to move it along, as he was saying, he doesn't care what the past history was. You know, how much blood, sweat, and tears and money you put into it. It's the state of the asset at the point you present it to him. Right?
There's definitely signals, right? A company that's 2 years been doing SBIR, they've been doing active research, not troubling. A company that's already spun out of a university and is 5 years later and is still living on SBIRs, bad signal. That actually starts to tell me not interesting, right? Because it means they've been unable to shift gears into a commercial phase.
Concerns with confidentiality when applying, any concerns with confidentiality with patent isn't
When applying to what?
for an SBIR. So you're applying, the patent isn't converted, stage, is there any reason from a legal or bureau's perspective?
Yeah, actually, I have heard cases where if you apply for SBI grant, the SBI reviewers themselves will steal your idea and apply for it.
I'm not overly worried about that. I am worried about the patent disclosure side of the equation. So, right, that's a ask your lawyer moment, because about what you can disclose in that process and what you cannot, and what's going to be considered confidential and what will not.
I would say SBIRs are considered confidential.
Yep.
However, it's as confidential as someone who reads it, forgets that they read it, and then talks about it,
That's
right?
what
So,
I'm asking, is, given that, let's say you file provisional, you're in the process, what are your thoughts? Did you apply for an SBR?
No, and the reason why was timing, to his point. It was like too little too late. Because, these typical funding cycles for SBIRs is, might be a year before you get the money. Well, I didn't have a year to wait.
The answer on provisionals is very complicated. Provisional patents only protect what's actually in the provisional. And since if you're in an academic institution, right, we work for Harvard Tech Transfer and MIT Tech Transfer, and we are fully aware that tech transfer offices, to make faculty be quiet and go away and go be happy, take academic papers, slap a cover sheet on them, and file them. Right? What does that protect? Maybe some things, maybe nothing at all. And sometimes people are of the incorrect point of view that because they have a provisional outstanding, therefore they can go disclose. And as it turns out, what they're disclosing may not be covered under the provisional and may not be what gets converted into a utility filing. So that's an it's complicated kind of moment.
Even if it is covered, you're still exposing people. I mean, that's the question. Is, let's say it's an early breakthrough technology, it's an early, you have to weigh that, right?
I'll weigh in a little bit. Once again, biotech is a little different. However, there are very, very, very few disruptive, what I'll call revolutionary technology, revolutionary ideas. I mean, there are very few actually. I mean, I can only name probably a couple off the top of my head. So if you're really worried about someone taking your idea and going and commercializing it, you have to ask yourself, is this really that defensible? And in certain instances, devices, diagnostics, pharma, there are certain pivotal patents that you have that you can really, block out certain markets, certain competitors out there. So I'm not, discrediting that. But generally speaking, you want to be cognizant of the fact that just because you have a novel idea, that may or may not really be a company maker, right? It's very, very few cases where it's been something that can really deliver a lot of value at the end of the day.
For biotech, it is more critical than almost anywhere else because the only thing you sell at the end of the day is basically the data in the patent suite, right? In every other kind of company, more likely than not, execution beats IP, particularly on the tech side. Device, diagnostic, it depends about what's going to be the biggest value driver. But the two things you can never get back, IP leakage and equity. Right? It's the two things never ever screw around with. Don't do it on cocktail napkins. If you don't know what you're doing, get help because you can't get it back. There was a question over here. No? Okay. Want to leave you with a couple of last thoughts, which is...
Can I just ask what are your thoughts on family offices and that source of funding?
The question is, what about family offices? For those who don't know, a family office is a generic term that is applied to usually when a wealthy family sets up a front end, some LLC, some LP, and it invests as an entity on behalf of the family's money, right? So in the food and bev space, Berlinvest, right? They're investing what was InBev money. Launch Capital here in town is actually a family office, meaning they typically have one LP or one trust that is their limited partner. Rather than raising it from institutions, they're raising it from families. Family offices come in varietals. They're even more widespread than VCs. There are some that are incredibly good and incredibly professional, and they know exactly what they're doing. And there are others where they decided yesterday, hey, everybody else has a family office, we ought to have a family office. And they hire some nice young MBA who has no idea what they're doing. And deal terms are all over the map. And other times you get family offices that have double bottom line priorities. They say, well, I want to go fix Alzheimer's. I don't really care if we make that much of a profit, right? So they have a very different point of view than a real financially motivated investor. Hard to find. It's the last bastion of things that are not transparent. They don't publish. They don't put up websites.
There is a family office association.
Yeah.
So there are governing bodies that try to create best practices, but family offices are probably even more difficult to get insight into who's out there, who's doing what, than VCs or angels.
Yeah.
So from a transaction cost perspective, are the legal and accounting costs higher for issuing convertible debt or equity?
Convertible debt will run somewhere between $5,000 and $20,000 on the company side, and you oftentimes are not paying investor counsel. Again, if you do a $20,000 convertible debt round for $150,000, you have made a poor choice. If on the equity side, you can do deals typically anywhere from about the $20,000 range up to about the $40,000 range, and you're going to pay investor counsel somewhere between $10,000 and $15,000. If you're dealing with the VCs, that cost on the VC side is going to go up quite a bit. So company side is going to be probably in the neighborhood of $40,000 to $50,000, and you're going to pay the VCs up to maybe $20,000 in legal fees. It ain't cheap. It's a lot of work.
So you had some closing thoughts. I think the panelists will stay for a few minutes to chat afterwards,
sure.
but you said you had some closing thoughts.
Yeah, I just, we have John.
Last question. Yeah.
Okay. Can't get out alive.
Can you make it unattractive if you raise a lot of money from family, friends and family with a convertible note? Can it be unattractive for angels or for VCs because you have either too many that will participate in the next round, or?
It's a great question. So
You're probably the one to answer it, right?
Well, what would be unattractive is if it's complex. Right, it's all about the complexity. If you say, you know what, it's my mom that has to sign it and she'll go along with whatever valuation you come up with, easy. I don't care. You can raise $20 million. It really doesn't matter, right? But if you have, either difficult investors, or if they have, so this happens actually fairly often in the world I live in. The family and friends invested at a high valuation, and they invested and they expect the next valuation to be a certain amount. Maybe you guided them towards it, or they heard from their best friend's daughter that Facebook just acquired WhatsApp or whatever, right? And the conversation becomes difficult when I have to not only negotiate with you as the founder or the CEO, but then I inadvertently have to negotiate with your investors who may or may not be rational. And at that stage, what I'll tell you is, you go figure that out and come back to me. Right?
Other things that screw up financings from prior rounds. You agreed on an interest rate or a discount that's out of market. So you do a convertible debt round and you tell people, oh, you're going to get 50% discount to the next round. Well, the new investors show up and go, that's lovely, but once again, you're going to have to go back and tell them that they're maxed out at maybe 10, 15, 20% discount, or we won't do the deal. Right? It's too much dilution on the company, right, to do that. If you have other wacky terms in there, you've agreed with your early convertible debt investors that they're going to get some number of board seats or some other term that's out of market, new investors will just say, I can do a lot of deals, and I'm quite happy to say no to this deal, right? So go fix that, then we'll talk. And so Yumin's exactly right. Vanilla, vanilla, vanilla. Vanilla is your favorite flavor of financing, right?
So actually, you basically bring up a good point. When you do multiple rounds of financing, guess what? It's the last money in that's the first money out. So really the last investors are the ones who have sort of the most active rights, and often in deals they'll change the rights of the prior investors. They'll say, if you're going to take our money, these people can't have these special voting rights. So it's interesting. You think logically that the people who gave the first money, have taken the most risk over the time of the company, but it really is turned around.
The only caveat, and once again, I'm probably shouldn't bring it up, but I will.
Yeah.
If you are doing spectacularly well, if you are in a market that's spectacularly hot, you may get away with basically pulling shenanigans because the new investor just wants to get in. I'll say, I'll take whatever terms you give me. That being said, that usually does not happen, right? So the new money coming in is saying, you want my money, it's going to be at a certain price. It's going to be, and I want this percentage of the company, and I don't care if you have to give your equity to your investors because you promised them certain things. I need this many board seats. This is what the construction of the board's going to look like. This is what the control provisions look like. Figure it out, right? And then depending on how you dealt with your family and friends, that may be a really easy conversation or impossible conversation.
And it's often a tough transition from angel financing to VC financing because, to an earlier point that was made, put yourself in his seat. Do you want 50 people having voting rights on something? It's tough, so there is a tendency to kind of, shut down the VCs, shut down the angels, rights and kind of limit their say, which can cause some friction.
I've had instances, not to once again carry on too long, but I've had instances where the board member or the investor has held the company hostage. So I love angel investors, especially smart angel investors that know the market, that can provide value is great. Or guys that give you money and sort of walk away and say, do whatever you want, that's also great. But depending on how you structure the deal, you may be held hostage. And I've had one situation recently where the investor said, you know what? I would like to buy my third house. And unless you give me 3x what I paid, I'm not going to sign any deal. Right? You're held hostage then. So it really depends on who you get as an investor and how beneficial or negative the family and friend is.
What is the normal discount rate for the convertible debts?
Market right now is an 18 to 24 month term. Max discount at 20%. A lot of times it's inclining every 6 months, so 5%, 10%, 15, 20.
20% APR or 20% total?
20% total. Okay? It's not an interest rate. The interest is on top of that. What I want to leave you with is I just put up the slide that just kind of shows stage. A couple of really useful things as early stage entrepreneurs, which is to remember that you have what you're passionate about and what your job is. Investors have what they're passionate about and what their job is. And the goal is to try and find some mutuality about where you meet up. There is not good investors and bad investors. Angels are not better or worse than VC. They're different.
There are some bad investors.
There are bad investors, but there's no bad class of investors for the most part, right? They have a job to do and things they're trying to accomplish, as are you. If you respect them and you demand and get their respect for what you're doing, right? You respect each other mutually. You can find great investment partners in this town. Boston has a phenomenal number of very high class angels and VCs, great service institutions, great service providers. There's a whole range of resources here in Boston that's really, particularly for life science, unlike anywhere else on earth. And it's an opportunity to say, okay, well, my company's going to need 30 million, so I need to craft it like this. Or my company can only really exit for 50 million, so I really need to think about my financing and my build in a certain way, because I need to make sure I'm honoring my priorities and their priorities, and I need to be able to walk into a conversation and say, here's how I'm going to be successful, here's how my early investors are going to be successful, here's how my last investors are going to be successful, right? This is the story, and when you do that, you build a very compelling case and hopefully a great relationship for moving forward. So that's my 2 cents. Thank you to the panel, if you would. We're going to stick around. Please make sure, if you have not already done so, that you've signed up with TCN for the newsletter and invites, and that if you're interested, you come to the May 28th Fast Track, again, all-day life science event, everything you wanted to know or didn't want to know about funding, including a phenomenal lunch mentoring program where you get to spend a lot of, I guess it's 1-on-3 time. It's usually about 3 or 4 entrepreneurs with about 4 or 5 investors sitting at a table and getting live feedback. So great opportunity. If you're interested in Launchpad on Demand, see Meredith. And with that, thank you very much to Harvard iLab.